Picture a 158-year-old Wall Street titan with $639 billion in assets. Now, imagine it vanishing over a single weekend. On Monday, September 15, 2008, Lehman Brothers filed for the largest bankruptcy in American history, carrying roughly $619 billion in liabilities. The lights simply went out. The global reaction was a violent shockwave. Stock markets plunged, money market funds broke the buck for the first time ever, and credit markets worldwide slammed shut. The panic traveled from New York to London and Tokyo in a matter of hours. A persistent public narrative often frames this collapse as a tragic accident, the result of unforeseeable macroeconomic weather and an unfortunate housing slump that caught everyone off guard. Internal records and the later bankruptcy investigation revealed a more calculated path to that Monday morning. Behind the headlines of a housing storm lay a 30-to-1 leverage ratio and a specific accounting maneuver designed to keep billions in liabilities off the public books. Lehman's filing represented something far beyond a standard corporate bankruptcy. It was the explosive exposure of a systemic rot, forcing the realization that no financial institution was truly safe. To understand the origins of that rot, we have to look back to the early 2000s. Under the intense, combative leadership of CEO Richard Dick Fuld, widely known on the street as the Gorilla, Lehman transitioned from a conservative bond trading house into an aggressive profit machine focused on real estate. The U.S. housing market was roaring. Home prices climbed steadily as buyers took out high-risk subprime and adjustable-rate mortgages. Lehman fed this machine, packaging thousands of these loans into complex securities and selling them to global investors, while quietly keeping many of the most toxic slices on their own books. To fund this rapid expansion, Lehman operated at extreme leverage. For every dollar of equity capital, they borrowed roughly $30. In a rising market, this multiplies profits, but the math is unforgiving. A tiny decline in asset value completely wipes out your underlying capital. By mid-2007, the housing engine sputtered. Home prices stalled. Borrowers defaulted as teaser rates ended, and the subprime market began to unravel. Lehman was left holding a massive portfolio of rapidly depreciating real estate. By pushing their leverage to the absolute limit, Lehman's leadership gambled the firm's existence on the assumption that home prices would never fall. Operating at 30-to-1 meant they had forfeited any margin of error. As 2007 drew to a close, executives faced a crisis. The firm was bleeding cash, and they needed a way to mask the losses buried in their real estate portfolio right before they had to report their quarterly numbers. To survive the scrutiny of regulators and rating agencies, they turned to a highly controversial accounting maneuver. Internally, they called it Repo 105. In a standard repo, a bank exchanges securities for cash, promising to buy them back. The debt stays visible. But Lehman exploited a loophole. By providing 105% collateral, they reclassified the transaction as a sale. $50 billion in toxic assets vanished from their ledger. Executives called this window dressing. It created the illusion of a healthy balance sheet, exactly when regulators were looking. Then, once the reporting window closed, Lehman repaid the cash and the toxic assets quietly returned. Repo 105 was a deliberate mechanism of deception. It allowed the firm to project stability to the public, even as it was internally bleeding to death. By mid-2008, the sheer volume of toxic mortgage defaults overwhelmed the accounting tricks. In June, the firm reported a staggering $2.8 billion quarterly loss, its first in 14 years. Short sellers circled, and the stock price collapsed. The crisis culminated in a high-stakes weekend from September 12th to the 14th. Top bankers from across Wall Street and key government officials were summoned to the Federal Reserve Bank of New York for emergency rescue talks. Behind closed doors, negotiations repeatedly collapsed. Potential buyers like Barclays and Bank of America walked away. Washington, bruised from earlier interventions, drew a hard political line. There would be no taxpayer bailout for Lehman's hidden toxic assets. With cash reserves drained and entirely out of options, Lehman officially filed for Chapter 11 bankruptcy protection at 1:45 a.m. on Monday, September 15th. The inability to find a buyer sent a terrifying message to the market. Wall Street's hidden risks had become too toxic for rival banks, or even the federal government to absorb. Because there was no regulatory mechanism to safely wind down a massively interconnected firm, Lehman's collapse triggered an overnight panic. Counterparties rose, liquidity vanished, and the U.S. government was forced to execute a hasty $85 billion bailout of AIG just days later to stop the contagion. The fallout quickly escaped the confines of Wall Street. The resulting credit freeze pushed the global economy into a deep recession, costing millions of everyday people their jobs, their savings, and their homes. Yet Dick Fuld walked away having earned hundreds of millions in compensation over the years. In subsequent congressional hearings, he remained defensive, insisting that Lehman was actually solvent and merely the victim of a sudden liquidity crisis. In the aftermath, sweeping regulations like the Dodd-Frank Act and mandatory stress tests were implemented. Banks are now required to hold significantly more capital to prevent a repeat of 2008. Modern finance rests on the fragile foundation of perception. When an institution uses gimmicks to manipulate its ledger, the resulting loss of confidence dismantles the collective trust that keeps the global economy functioning.